Welcome to the Broken Pie Chart Podcast, episode 106. I think it's 106. Yes, it's 106. I'm your host, Derek Moore, and this week we're going to be talking about the interest rate shock that happened last week. Is that predicting greater outsized inflation that maybe wasn't there before? Seems like there's a lot of talk about how inflation could be much higher than the Fed is talking about. We'll also go through some of the year-to-date numbers on especially longer-dated bond ETFs and funds having a tough year due to the rise in rates. And I also want to cover some interesting things in the TIPS market. That's Treasury inflation-protected securities, and where the Fed now owns about 30% of that market, where they've bought it, it's on their balance sheet. And does that skew or kind of mess up the way we look at break-even inflation? I'll explain what that is. So without further ado, what happened this week? Well, we had a spike in interest rates, and we had a spike in rates that was pretty historic on a percentage basis. So Thursday, all of a sudden, when I say a spike in rates, we're talking about, the spike or the interest rate on U.S. Treasuries, so U.S. government bonds. And to put this in perspective, on Thursday, we saw about a 33% rise in the rates. They went from 60 basis points, which is like 0.60, 0.6%. At one point, they spiked. I think they spiked all the way up to like 0.85 or something like that. But they settled up above 0.80, and that 33% raise in or change in the rate. Look, I went back and pulled data as far back as I could, back to 1962 on the 5-year Treasury bond. And that's 14,000, oh gosh, what was that? It was like 14,700 days. And what I did was I looked and I said, okay, how historic from a percent change in, the rates, up or down, was that? Well, it actually wasn't the top, believe it or not, surprisingly enough. And I'll tell you when that was. But it was the second highest percent change in rates ever. Well, ever going back to 1962, where I could pull the data. And rounded, it's about 34%. So that's pretty historic. And I also went back and I said, well, let's look and see, what would be a one standard deviation up or down change in rates. So, of course, you take the average and you look at, once you have the average, then you look at the deviation from the average. And one standard deviation, if my numbers are right, was about 2.17%. So 68% of the time, rates don't change, outside of that range, right? So 33 or 34%, if I'm doing the quick math here, that's like a 16 sigma event. Let me just do my calculate. Now about 15.7 time or 15.7 standard deviation move. So that's pretty wild. I don't remember what the equity market in 87, how many standard deviations that was. I think that was similar. Maybe it was a 20 standard deviation move. I'd have to go back and look. I should have done that before the podcast. It's one of those things I just thought of as I was talking to kind of put it into perspective. Of course, 87 was when the market crashed. The Dow was down like 20%, over 20%. So really historic. And here's the thing. Now, I will say that, if interest rates are 4%, that would have meant that, for a change in rates equal to what we saw on Thursday on a percentage basis, that would mean like, hey, interest rates are 4%, and the next day they go to 5.36%. So a lot of people say, look, this number is so low that any significant move is going to be a higher percent, change. And people aren't wrong who say that, okay? They're not wrong. But regardless, that's a lot of volatility with regards to, to the change in rates. So here's the other thing too, I'll say in this. We know that, duration matters, and the duration is really the sensitivity to changes in interest rates. So when you have, a duration, well, here, I'll put some numbers on it. So modified duration or duration is one of the ways that you would actually go in and say, hey, for every 1% change in rates, full 100 basis points change in rates, what would be the change in the price of the bond? And so a 5-year bond that had, let's say it started out with a coupon of 0.6%, its duration was about 4.9 years, which means if you had a full 100% basis point, a full 1% change in rates, on Thursday it was about 20 basis points, 60 to 80 basis points about. But if it was a full 100 basis points, like if it went from 0.6 to 1.6, you would expect to be down about 4.9%. So, with the move the other day, it was a change of around, it was over 1% down that those bonds experienced. So, for sure that was a big move. But to give you an example here, if we, I don't want to say normalize, but if we had a 6% interest rate, let's just imagine that rates were 6%. The duration actually goes down from almost 5 to about 4.2 or so. And duration on longer dated bonds is much greater, and it's much greater the number of years to maturity, and it's much greater the how low the coupon goes. So very historic. Now, you didn't ask me this. Well, you can't ask me this because I'm recording this, but I was just curious, did we see a cluster of, when was the last time that we saw this craziness in rates? And the answer is, it was actually in March of last year. In fact, if I do a search and I say, hey, show me every 20% move or higher, besides yesterday's move, all of these were basically up and down. They were all in March of last year. Remember, we were in the throes of the market dropping and the Fed coming in, moving rates to zero and everything. But we saw actually the highest ever was on March 10th of last year. It was a 43% increase in rates. But believe it or not, March 16th, rates went down 30%. So interest rate volatility is definitely something to watch. And when you see volatility in the rate markets, it's also a little bit unsettling. So with the rise in rates, though, one of the things we've seen too is a lot of these bond funds that, especially on the longer end. So for example, there's a PIM code, 25 plus duration, years to maturity, we'll call it. And that's zero coupon, meaning they don't pay a coupon. So pretty much if it's a 20-year bond, it's modified duration is going to be 20. So that's your sensitivity to every 1% change in rates. Year to date, it's almost down 17%. 5 to 7 year treasuries are down almost 2%. 20-year treasuries down a little over 12. And the AGG, the Aggregate Bond Index, year to date, is down almost 3%. So those are things, and I thought it was interesting too. Normally people, and this is one of the attractiveness of the 60-40 portfolio is the idea that, hey, we have a bunch of bonds that will go up if the market goes down. Well, guess what? On Thursday, bonds were down and the market was down. Bonds offered no protection when the market was all the way down. So, definitely if we see a situation where interest rates are causing spiking or causing equities to go down, it would sort of break that 60-40 portfolio. Of course, I've done many episodes on alternative ways to hedge and the idea of buying and hedging and putting real floors in portfolio. And we've also done sort of the myth of the 60-40 portfolio and some of the challenges there. I'll try and link to those in the show notes because you may find those interesting. So a lot of what people are talking about is this idea that, a lot of inflation's coming. And so the money supply has been increasing. We know that. This new stimulus bill is going to pass, and, they're going to have a lot of stuff in there. They're also going to have some pet projects, and I'll call it quote unquote, pork projects that are in there. I saw somebody wants a bridge, somebody else, I forget. You can read it. I'll leave that up to other people to discuss. But anyway, it's a lot of people view that as inflationary. And so you're increasing the money supply. In fact, the money supply, I think, was up 28% year over year, February of 20 to February of this year. And the money supply, usually it's M2 or MZM, which is kind of like near money. These are all available from the Fred site, FRED. Federal Reserve puts this out. Although I think they're discontinuing MZM because some of the components are being discontinued. And there's also going to be some changes. I haven't dug into it quite fully yet to how they do M2. Of course, they stopped reporting M3, I think in 2009. But, a lot of people looking at this as inflationary. And so there's a couple things that you can look at. I'll link, of course, to the CPI, the Consumer Price Index. But if you look at the Consumer Price Index, and that measures the theoretical basket of good, and it's weighted. And so, food is about 14% of that. And then you have, subsets of that. Then you have energy. Energy is over 6%. And, you've got all sorts of things. And, like new vehicles has about a 3.7%. Used trucks and cars, there's apparel. One of the biggest ones is shelter. And that's either rent of primary residence, that's about, almost 8%. And then owner's equivalent rent of residences. Maybe you could do a whole podcast on what the heck that is. But that one's about 24%. And so shelter's 33. But owner's equivalent rent is like literally kind of like a survey where they go out and they ask homeowners, hey, if you're going to rent out your house, what would you charge? A lot of people think there's some issues with that one. Some people don't. Maybe that's, I could do a whole podcast on that. So all these things are weighted differently. For example, bread has a 0.2% weighting. And so if bread, went up by 100 times, all else equal, it would cause a rise, but it's sort of a lower rated thing. So I'll link to this. The CPI comes out. I think February's will come out soon. And one of the things that you look at is you look at the month over month change. So for example, you would look at this February compared to January. And then you also might look at this February compared to last February. So for example, in Jan 2020 to Jan 21, you look at the change in, some of these items. And one of the things in general, like, if you look at energy, January of 21 to January of 2020, energy last month was down, almost 4%. Motor fuel was down, 8%. Fuel oil was down 16%. So I think when the February numbers come out, and those will come out in March, likely you'll see a jump in those. But certainly, this is one of the things that people look at, and they look at trends. And the Fed also seasonally adjusts some of this stuff. So when you seasonally adjust it, you might smooth it out a little bit more. But I bring this up because likely you're going to start to see, because remember we had the really harsh lockdowns back in February and in March. Well, I guess it was March of last year. And then I think it was March, April. Yeah, it was kind of, so you're going to see some, assuming we stay unlocked, I guess that's the right way. I think you're going to see some year over year that seem like they're a little bit outsized. because you had a lot of things closed down. So that's one thing to keep in mind as you start to see these prints come off of CPI. In Europe, I think the latest, I think they do IPC or is it HCIPC? I forget. But their most recent one was about 1.9, and that was sort of there's two ways of looking at it. There's the core, and then there's the core. Core is less food and energy, which tend to be volatile, and there's the all items. So about 1.4% was the last one that came out in January for us. I think Europe was like 1.9%. And I think the core was less because energy kind of dragged it down. Is that a word? So anyway, but I bring this up because I think the inflation trade, or there's going to be outsized inflation, is definitely a crowded trade, and there's a lot of people on that side, and people have been waiting for many years for inflation to come back. So whether it does or not, it remains to be seen. I will say, though, that there's a good correlation between what's called the velocity of money and inflation. And the velocity of money is basically you take your GDP divided by the money supply. And the last time I ran this, I guess I'll have to start doing it off M2 instead of MZM because they're discontinuing that. But the last time I ran this, the velocity of money was only slightly above 1. And that was for the whole year of 2020. The last couple of months, velocity has been below 1. And so when we had really high inflation, for example, we had inflation that was 8% or more, money velocity tended to be above 2.5 times. And money velocity just means, remember, it's just how many times does that same dollar get circulated. So you buy a paper, that person buys a slice of pizza, that person buys a cup of coffee, that person buys whatever they buy, right? But if the same dollar is slower to move through the economy, you have lower velocity. And I bring this about because while certainly you would expect money printing to cause a lot of inflation, and it still may, so far the velocity of money has not increased. In fact, velocity of money continues to drop. And so if you do a regression analysis and you do and you kind of look historically, I have numbers from 1960, money velocity is not pointing to inflation, but we'll see. We'll see what happens. And other people point to, hey, look, CPI might not be going crazy, but fresh food was up, over 3%. And other aspects, used cars have been up, and things like that. So, these are these are sort of important things to look at. There is an interesting thing too in the market forecast of inflation. One of the ways that things that people follow is something called break-even inflation rate. And basically, break-even inflation rate, you take the yield on the nominal Treasury. It means just the normal Treasury, and you subtract it by the equal maturity TIPS bond, Treasury inflation protected security. And so if, as an example, let's say that the 10-year Treasury is yielding 5% and the TIPS yield for 10-year Treasury inflation protected security is, 3%. So you would take 5 minus 3. The expectation over the next 10 years, at least according to the bond yields, would be inflation of 2% annual. So recently there was a little bit of an interesting development in the break-evens, and that, number one, they're spiking both in the 5-year break-even rate. It's now 2.39%. And the 5-year rate has also inverted with the 10-year break-evens, meaning the 5-year break-even is higher than the 10-year break-even. And at first blush, you'd say, okay, Well, that's predict the market saying inflation is going to be higher in the next 5 years than it will average over the next 10 years. So we'll see a rise and then a lessening. So break evens have their issues. Over the longer term, if you look at break evens, they've tended to average, a little over 2%. And guess what? That's sort of what inflation is. You see these drops when you're in really bad, the teeth of recessions. For example, in November of 2008, the break even was negative 1.79%, which said over the next 5 years, we think we're going to average deflation of negative 1.79%. And in fact, earlier this year, in 2020, March 19th of 2020, inflation, the break-even rate was 0.14%, essentially meaning you're going to have no inflation, no deflation. You're going to essentially be flat for the next 5 years. So it's you kind of see what it is. It's just taking one rate minusing the other. So I bring this up because one of the things I think that we're seeing in the bond market is the Fed now owns, I think I saw, according to something I was reading, they own about 30% of the TIPS market, meaning the Fed has actually gone out and bought TIPS bonds and put them in on their balance sheet. And by the way, they're buying treasuries. Heck, they've actually bought high yield. They've bought some corporates and things like that. So why do I bring this up? Well, I just pulled up a sample of a 5-year TIPS bond. And so 5-year is going to mature in 2026. And I'm just looking, the yield to maturity on these things are minus 1.63%. Meaning that, it's saying you're going to have a negative return on these according to the yield to maturity. So I bring this up because we know that the 10-year Treasury, in fact, if I pull it up, the 10-year Treasury yield, I guess I should do the 5-year. Yeah, 5-year Treasury yield right now. I think I mentioned it sort of close to the opening, right? It spiked, and on Thursday it was 0.81. And so if you take that, and then you subtract it by your negative yield to maturity, that's how you have that. I mean, you have a pretty wide gap, right? So, in other words, in this case, you'd wind up with the 0.81 plus the negative 1.6. So that gets you to your 2.4 break-even rate. But I bring that up because it's just kind of interesting if you have the Fed that has bought all these bonds and pushed up the price on TIPS so that their prices, when you buy them, you're paying so far above par, even including the dividends that you get, it's still a negative yield to maturity if you come down to the inflation-adjusted par value that they do. And I'll try and link to, I think I did an episode on TIPS bonds that I'll link to. I bring that up because I wonder if the break-evens are not giving a totally accurate view of what future inflation will be right now. And look, I'm not making a prediction that we are or not going to have inflation. The way that you want to watch this, watch the break-evens, watch the bond market, watch the CPI, watch these numbers, and you're going to see whether or not inflation is playing out, and it will be pretty clear. But anyway, that's kind of what I wanted to talk about this week. I think we don't always talk about interest rates. We don't always talk about break-even inflation and TIPS bonds and all those sorts of things. The CPI is a little bit dry, but as it comes out monthly, and that's going to give you a good indication of prices. So, and by the way, the situation where we had yields rising and market going down the other day, I actually wrote about that in my book, Broken Pie Chart, available on Amazon. I recommend people get it. It'll be a great, what holiday do we have coming up here? We already passed a bunch. It'll be a good Easter present, but you should order now. Order it like today. But seriously, in the book, I I kind of wrote about the scenario. I wonder if we did have a situation of rising rates and spiking inflation, and I wrote that in the context of how the 60-40 portfolio may potentially not help you there and the need for alternatives. So, all right, with that, please share this episode with somebody, especially somebody who's never listened to podcasts, or maybe people who do listen to podcasts. Go ahead and take the link, share it to them. They can pull it up on their iPhone app, their Android app. I was going to say a Microsoft phone app, but you shouldn't have one of those anymore. And then, just pass it along. I'm sure you can rate it and review it. And we got a new 5-star rating recently on Apple. Appreciate that. But go ahead and share this. All right, we'll talk to you next week, and we'll be back then.